Payroll isn't just about paying employees. That's a big part, of course, but it's also about the financial management of payroll data. And that's why payroll journal entries are an important part of payroll. In this video, we'll walk through payroll journal entries step by step and also discuss the importance of payroll accruals and reversals. The starting point for preparing a payroll journal entry is the payroll register. In its simplest form, the payroll register shows a summary of the employee's gross pay, federal income tax, Social Security, and Medicare tax, as well as state tax, any other deductions such as 401k, and net pay. Depending on the size of the company, the payroll journal entries may be split between departments and locations as well. So in short, it can be relatively straightforward, but it can also be quite complicated. If the company is using payroll software, the journal entry may be automatically prepared and can be posted to the general ledger when the accountant approves it. If the company is using a payroll vendor, the vendor may provide the journal entry. However, the accountant must be able to understand what should be recorded and double-check the journal entry to ensure that it is indeed correct. Also, during an audit, accountants often answer questions related to the payroll entries and therefore must clearly understand why an entry was recorded and posted. For instance, auditors may ask for the payroll register for the entire year and how that register reconciles to all payroll journal entries that the payroll accountant recorded. Let's look at the example from our textbook. L&L Grain pays its employees biweekly and operates on a calendar fiscal year, which just means that the company's financial statements are prepared for the time period from January to December. Many companies have a fiscal year, which means that it begins in a month other than January and ends in a month other than December. Some companies use a fiscal year because it more adequately reflects the seasonality in their business. For instance, Apple has a fiscal year ending in September. In our example, the payroll accountant for L&L Grain has completed the payroll register and issued checks for the January 26, 2024 payroll. Paychecks will be issued on January 31st, 2024. The payroll register shows us the gross pay of $18,050 as well as withholdings for federal income tax, Social Security, Medicare, and state income tax, as well as deductions for 401k contributions, health insurance premiums, and donations. In addition, we see the net pay and the employer share of the taxes. This is the information we need to record the payroll journal entry. But I have learned from experience that it's best to first double check that the gross to net math is correct. So add up the net pay and all withholdings and deductions that should equal the gross pay. Sometimes you'll get a report and for one reason or another, it is incorrect. So before starting with the journal entry, complete the basic due diligence and check the math. There are 4 steps to recording the payroll journal entries. In the first journal entry, we record the gross pay as the salaries and wage expense, which means that we debit that account. All withholdings and deductions and net pay are recorded as a liability, in other words, a credit. So for L&L Grain, we debit salary and wages expense for $18,050. We credit federal income tax payable for the federal income tax withheld of $1,500. We credit Social Security tax payable for $1,084.38, Medicare tax payable $253.61, state income tax payable $577.60, and we credit the deductions for 401k $750, health insurance premiums payable $560, and United Way contributions payable for $180. Then we also record the liability for the net pay and salaries, and wages payable by crediting that account for $13,144.41. As always, the total debit should equal the total credits. The second transaction reflects the actual payment of the net pay to the employees, which releases the liability that we previously recorded to salaries and wages payable. The second transaction is recorded by debiting salaries and wages payable and crediting cash for $13,144.41. The employer is responsible for paying all voluntary deductions such as 401k, health insurance, and contributions. For our example, that means that we debit the 401k for $750, health insurance premiums payable for $560, and United Way contributions payable for $180. And then we credit the cash account with a total of $1,490. The employer's share of the payroll taxes must be recorded as well. That's the next step. In this step, we record the entire amount of the employer's share of the taxes as a payroll tax expense, and then record each liability to the appropriate liability account. So let's look at this entry. On January 26, we debit payroll tax expense for $2,387.39. Credit the Social Security tax payable for $1,084.38. We credit Medicare tax payable for $253.61. Credit the FUTA tax payable account for $104.94. And we credit the SUTA tax payable account for $944.46. Many companies also match the employee's 401k contributions and pay part of the health insurance. If that is the case, these entries would debit the applicable expense account and credit the applicable liability account. Just in case you're wondering, payroll accounts often use Excel functions such as VLOOKUP, XLOOKUP, and SUMIFs to link the payroll register to the journal entries to avoid having to manually type all these numbers. That's a good practice because it's really easy to type the wrong number. Here's another example. Giblin's Goodies pays employees on Friday, August 16th for the prior week ended 8/9/2024. The gross pay is $4,500 and it shows us the withholdings and the net pay of $3,545.75. In addition, we see the FUTA tax and SUTA taxes. We start with the first entry on 8/9/24 and record the payroll register amounts with a debit to salary and wage expense for $4,500, and we credit federal income tax payable for the federal income tax withheld of $520. We credit Social Security tax payable for $279, Medicare tax payable for $65.25, state income tax payable for $90, and record the liability for the net pay and salaries and wages payable by crediting that account for $3,545.75. As always, the total debit should equal the total credits. With the second journal entry, we record the payment of the net pay to the employees by debiting wages and salaries payable and crediting cash for $3,545.75. In this example, we don't have any additional withholdings like we had in the example from our textbook, like 401k or health insurance deductions or contributions. That is why we don't have to record that entry and can move on to the last entry. To record the employer share of the payroll taxes, we debit the payroll tax expense for $614.25 and credit Social Security tax payable for $279. We credit the Medicare tax payable account for $65.25, credit the FUTA tax payable account for $27, and we credit the SUTA tax payable account for $243. A common occurrence is that a payroll period may be split between 2 months. Either the payroll period spans the 2 months, meaning the payroll period starts, for instance, in March, but ends in April. Or the payroll period is in 1 month, but the pay date is in the next month. Accountants, though, want to match the expenses with the revenue they help generate. This is called the matching principle. That means that we need to record expenses when they are incurred. We can't wait until they're paid. So let's look at this example here, where the payroll for March 25th through the 29th will be paid on April 5th. The March 24th month close would not be complete without the payroll expenses for the payroll for March 25th through March 29th. And in practice, your approach will likely depend on how fast you receive the payroll reports from the payroll team or vendor and how short your month closes. For instance, if you don't receive the payroll reports in this example until April 4th, but your month close ends before you receive the reports on April 3rd, you will have to estimate the payroll costs based on the prior payroll period or some other fairly accurate method. So that's approach one, estimate the cost for the payroll. On the other hand, if your month close doesn't end until April 5th, then you can use the actual payroll report to accrue for the exact payroll expenses. So let's assume that you have until April 5th for recording month close adjustments and can use the payroll reports that you receive on April 4th to record the entry. In this case, you first record the payroll expenses and liabilities based on the payroll register, and then record the employer share of the payroll taxes. However, in addition, accountants reverse these entries at the beginning of the next month. And most systems do that reversal automatically if you check the system box for auto reversal. I know that sounds a bit confusing, but I'll explain it in detail. In the first journal entry, we debit the salaries and wage expense account 511 for the gross pay accrual of $16,245. Then we record all withholdings as credits because they're liabilities. Federal income tax payable account 221 of $1,350. Social Security tax payable account 222 of $1,007.19. Medicare tax payable account 223 of $235.55. And state income tax payable account 224 of $519.84. And finally, we record the net pay as a liability in account 231, sales and wages payable of $13,132.42. Next, we record the second journal entry to accrue for the employer share of the payroll tax expenses by debiting account 512, payroll tax expense for $2,217.44, and crediting all liability accounts, Social Security tax payable 222 for $1,719, Medicare tax payable account 223 for $235.55, UTA tax payable in account 228 for $97.47, and SUTA tax payable in account 229 for $877.23. So now let's talk about reversals. In many companies, the payroll entry interfaces automatically from the payroll module into the general ledger. Or the payroll vendor provides a file that can be imported into the general ledger system. So this process happens regardless of whether an accountant has accrued for the payroll already in the prior month. So to avoid duplication of the payroll expenses and liabilities, meaning the accrual in March and the actual payroll entry in April, the general ledger accountant typically reverses the payroll accruals on the first day of the next month. In practice, the accountant only clicks the auto reversal box when entering the payroll accrual, and the system will automatically record the reversing entry on the first day of the next month. So when the actual payroll interfaces or is imported, the reversing entries will offset the actual payroll. So let's practice the reversals so that you're familiar with that. The reversals are exactly that. The accountant reverses the prior journal entry by crediting the accounts with debits in the prior journal entry and debiting the accounts with credits in the prior journal entry. So the first reversing entry on April 1st debits all of the liability accounts. Federal income tax payable, account 221, 1,350. Social security tax payable, account 222 for 1,719. Medicare tax payable, account 223 for 235.55. State income tax payable, account 224 for 519.84. And salaries and wages payable, account 231 for 13,132.42. And credits the salaries and wages expense account 511 for $16,245. We also reverse the accrual of the employer payroll taxes by debiting Social Security tax payable, account 222 for 1,719, Medicare tax payable, account 223 for 235.55, FUTA tax payable, account 228 for 97.47, and SUTA tax payable in account 229 for $877.23. And finally, credit payroll tax expense in account 512. Here's another example where the payroll period is split between 2 months. July 29th to July 31st need to be accrued for July, but August 1st and 2nd belong into the August month close. The payroll is not paid until August 9th, and our month-end close ends on day 5 of the following month, August 7th. We can't prolong the month close to wait for the payroll report, so we'll have to estimate the accrual based on the prior payroll period. Now, it's important to use good judgment and ask the right questions, which should be, is the prior payroll a good approximation for your accrual? Now, if the prior payroll included one-time bonuses, then perhaps it is not helpful for our accrual, and we may have to remove the bonuses from our calculation for an estimated payroll accrual. For simplicity, we'll assume that the prior payroll is the same as the payroll we used in our prior example. We divide each line item by 5 workdays and multiply each by 3 for the 3 workdays in July. In the first journal entry, we debit the salaries and wage expense account 511 for the gross pay accrual of $9,747. Then we record all withholds as credits because they're liabilities. Federal income tax payable, account 221, $810. Social Security tax payable, account 222, $604.31. Medicare tax payable, account 223 of $141.33. And state income tax payable, account 224 of $311.90. And we finally record the net pay as a liability in account 231, salaries and wages payable, for $7,879.46. Next, we record the second journal entry to accrue for the employer share of the payroll tax expenses by debiting account 512 for $1,330.46 and crediting all liability accounts. Social Security tax payable, account 222, $604.31, Medicare tax payable 223 for $141.33, FUTA tax payable in account 228 for $58.48, and SUTA tax payable in account 229 for $526.34. For the reversal journal entry on August 1st, we reversed both entries that we recorded on July 31st. As I mentioned before, many software programs automatically record the reversals if the accountant checks the reversal option when recording the accrual. The first reversal debits all the liabilities that we previously recorded for the amounts withheld from the employee's paycheck and credits salaries and wage expense account 511 for $9,747. The second reversal journal entry reverses the employer tax liability entry we recorded on July 31st by debiting all the liability accounts and crediting the payroll tax expense account. That brings us to the end of this video. As I mentioned at the beginning, payroll journal entries can be pretty straightforward, but also quite complicated depending on the size of the payroll, if the company splits the payroll by department and location, or other factors such as projects. In addition to reconciling the payroll expense accounts for the auditors and staying on top of reconciling the liability accounts with the payments can add additional complexity. I hope you found this introductory payroll journal entry video helpful, and you now feel confident in recording basic payroll journal entries, accruals, and reversals.